We're live, man. What's up, everybody? We're getting set up. It's been a crazy Friday, so just welcome to our first inaugural Facebook Live event. I'm Jonathan and Austin's still getting a couple of things set, so we're going to let people chime in and get set up. I know we were, a lot of closings on Fridays, and so we are doing some last minute items, but we're kind of fired up over here. We're ready to give you some big changes, some big updates. I know a lot of you might have seen my preview that I gave the other day about some of the Covid-19 changes that's impacting anyone in real estate, especially on the lending side. And we're going to get going right now, sometime really soon. So grab a drink. We got topos. Comment. Let me know what you're drinking. I got the twist of lime. That's kind of my go-to. And of course, I got my network funding koozie. And we're going to get going in a second once Austin joins us. And we let everybody chime in. So go ahead and start commenting, say hello, say what's up. We want to see who's here and give us a shout out. Hopefully a lot of referral partners that we work with are able to make it, or friends of ours, or anyone interested in what we're going to be talking about here today. So we appreciate you guys being here, and we're going to get rolling pretty soon. And if you haven't noticed, we have a lovely background that we made. And we are in Austin's garage, so we're sticking with the quarantine ordinance. And, I just drove over. Austin and I just live a couple of minutes apart, so we've been working from home. And we're going to do this video in our makeshift studio, we call it. And I'm sure you saw our updates last week as well. So.
What's up, everybody? Happy Friday. We're just, like Jonathan said, trying our hand at Facebook Live for the first time ever. So it could be a disaster.
Yeah, I mean, right now we're like...
Our stress level's high right now.
Because we're like, I thought it would help us.
Yeah, there were things that we thought were going to happen that didn't happen. So we're scrambling right now. One of the things I'm trying to figure out is... figure out how to see the comments.
Yeah, but just go like you're a user.
Not like I'm...
Yeah, just go to...
Okay.
Just go to our page and just join it.
So like Jonathan said, one thing that would help us right now is if you're watching, give us a comment and let us know what you're drinking. If you're not drinking something right now, what you're going to be drinking as this thing goes on or when it's over. So that would help us to see that right now.
There you go. Scroll down.
Here we go. Live.
There we go.
Here we are.
Magic. Just trying to get a laptop so we can see comments a whole lot easier.
Woo! There we go.
There we go. And we had a little outline. Did you figure out how do you want to do the outline so we can...
Yeah, let me get that pulled up here.
There we go. I can see everybody. Who we have here so far? Awesome. Jill's there. Kirk's there. Awesome. See some people that are past clients of ours are here as well. So excited to see. Let me turn the camera a little bit. There we go. Just trying to fix the camera. Austin's got his kayaks, canoes, all that fun stuff back here. So we're just, I guess the easiest thing I can say, guys, is, we're all in this together. We're all have kids at home or spouses that are working from home or all these things or friends that are getting furloughed. It's a crazy, unique, unprecedented time. So Austin and I are doing something unprecedented, hence why we're doing this Facebook Live video. And we're just going to go over some of these things and love for you to comment once we get into it. And, we're here to help. And there's some important information we want to get out. And we thought this would be the best tool to do it. So I guess we'll cheers and, our inaugural Facebook Live event.
Here we go. Here we go. Let's see what some of this Some of these people have said, nice garage. Thanks, Jordan. Yeah, did you tell them we're in the garage?
Yeah, I said this is our makeshift home studio at Austin's garage.
I've dubbed it the sweatshop. So that's where we are right now. So let's see.
How's the audio? Can I get some thumbs up on the comment? Is the audio good? Can everyone hear us clearly? I think there's a little bit of lag between the laptop and here, but
yeah, all good. All right. Welcome, guys. What we want to go over today, we'll give you a quick overview of everything we're going to hit. We're going to go over first the logistics. So logistically, what's happening right now in the real estate industry. We're going to give you a high-level recap. So why are these things happening? I mean, obviously, we know the coronavirus is what's causing it, but what effect is that having on the mortgage lenders, the servicers, the rates, all that? And then we're going to move into probably most importantly, and the reason we're doing the video today, are all the temporary loan program changes. So everything is getting affected. We want to give you a walkthrough in depth of what's happening and why those changes are taking place. And then we're going to, before we end it, we're going to talk about forbearance. So you've probably heard some of the information that's been coming out from the CARES Act. And we want to talk to you about what we know, and more importantly, all the things that we don't know yet about what that means for you as a consumer. And then we'll close it out with some Q&A. But feel free to type some comments. We'll try to pay attention to the comments as we're going here. So feel free to let us know if you have any questions as we go. JB.
All right.
Hit us with
the big logistics
changes. Yeah.
So the biggest thing to know is real estate is deemed an essential business, and so is banking, and so is lending. So we're still rocking and rolling. Network funding was already set up to be globally remote. All the processors, funders, closers, underwriters. So it was just a switch where everybody was able to be remote without hindering any of our closings and things like that. So we're still working. We're still getting after it. We had some closes today. We have things closing on Monday. So we're still rocking and rolling just like everybody else, and we're just getting used to this new temporary normal. The big thing around logistics, though, is the turn times. And so a lot of other lending institutions are really bogged down in underwriting. But at Network Funding, especially at Bunkin Baker, we've done a great job in our branch of handling this huge influx of refis that we're very grateful for. We're excited to have, excited to work with borrowers on all that. But we're kind of sharing with them about, hey, let's move you to a 45-day lock. That way we're not stressed to get you to closing, because there are people who are moving, who are buying and selling, and there's a lot of purchase transactions. So we want to make sure we take care of those people, Austin. So we made sure to prioritize all our purchases. And because of that, our underwriting times right now are still 48 hours.
It's crazy.
That is amazing. There are big lending institutions that are 2 weeks, maybe 3 weeks right now. And so our underwriters are kicking butt. So I'm just like, kudos. If any of our underwriters are watching this or might watch it later, we love y'all. We thank y'all for everything y'all are doing. People are putting in 12 and 14-hour days. So we're very grateful for that. So we're still doing 10-day closes. We get that question a couple of times. Are y'all still doing 10 days with everything going on? The answer is yes. We haven't closed on one like this week, but I closed one about a week and a half ago, maybe 2 weeks ago.
Yeah, and we've got a couple of others that are trying to go under contract.
Yeah, so we have some 10-day offers being made, but we're still doing 10 days. So that's how good things are going here.
It's amazing. Yeah, and it's really neat to be able to, from the top down at Network Funding, not just at our branch level. Obviously, we prioritize purchase business, but from a corporate level. I mean, right now with the crazy volumes, it's really important that we're in sync with the entire company as to where the priorities are. And the priorities are and always will be with the purchase transactions. And so that was really good that they started pushing us to do the 45-day locks.
Yeah, exactly.
Keeping the pipeline clean.
So the two big logistical changes that we want to share today is appraisals. Typically, an appraisal takes 5, maybe 7 business days. That's pretty typical. Right now, we're seeing 15, sometimes 18 days because the appraisers have all these refis, and there's just so much business, and there's not enough appraisers out there.
Yeah.
So we've seen a lot of that delay.
Same with the title companies as well. And so while we can prioritize, how we're working through our files, the appraisers and the title companies don't have the same luxury. And so they've got to handle the things as they come in. So you're going to see some longer turn times with appraisals. You're going to see some longer turn times, with the title companies. And so
Carbonation, man.
Carbonation, Topo Chico.
Gotta laugh when
Yeah.
it gets you.
But that being said, as long as we have appraisers and appraisal management company that's dedicated to maintaining our 10-day closing program, and so those are still getting done, like Jonathan was saying. Title companies hate us right now for those 10 days, I'm sure.
Yeah, but we can make them happen. That's the most important thing.
Yep.
So we talked about logistics. The next big thing is just a high-level overview of the interest rates, all the Fed cuts, and everything that's going on. Austin, why don't you drive us into that?
Woo! I'll do my best. So we put out a video a couple weeks ago when the Fed made their big announcement that they were dropping their rate to 0. That was obviously not for consumers. That's for the lending institutions, the banks, and everybody that borrows. You trying to scroll down there?
There we go.
There it is. And so right after the Fed made that announcement, mortgage rates actually launched. They skyrocketed. And
Crazy.
Yeah, the craziness has begun. And then about a week later, they came out and announced that they were going to start buying up to basically an unlimited amount of mortgage-backed securities. That piece actually really helped consumers. And so that provided the stability. They're letting the financial institutions borrow their money from the Fed at next to nothing. And then they're coming around on the back end and buying all of that, those low interest rate loans that are coming out. And so that's good for the short term for consumers and for kind of helping provide some stability to the rates. What that has also done is it's started to have an effect. The servicers, the entities that own the mortgage loans and the ones that service the mortgage loans for the investors that own them have gotten hammered over the last month. Obviously, everybody's refinancing, and so
they're getting paid
they're
off.
making less. Those loans are getting paid out of their portfolio, and they're really getting slammed right now. And so what that's doing is, and we've I don't think we shared the video from the RE guys about how they break down the effects.
On the servicing.
We'll post that to our page later today if you're interested in understanding.
But just know that if your whole entire company and business is built around servicing mortgages right now, you are bleeding. You are hemorrhaging right now.
Yeah.
Just like the airline industry or a hotel or any of that. Like the restaurants.
And it's not going to get any better unless the government steps in and helps on the servicing side, right? And we'll get into that more later, but the whole ability for people to request forbearance on their mortgage. Now, not only are the investors getting hurt by all of the refis,
early payoffs.
Now all these people are being told that they don't have to make their payments for 3, 6, 12 months, and literally that's brutal. So
that's why I like the way Austin said that the Fed is kind of bookend
Yeah.
the mortgage industry. I don't know if you shared that term, but I feel like that's a good way to look at what the federal government has done. They've helped it, but then unintended consequences.
Yeah, now we're seeing a lot of pain on the servicing side. So what has that done to the lenders and the investors out there? Well, essentially 3 things are happening. 1, some are just getting out altogether. So imagine if you had, $1 billion servicing portfolio before the coronavirus, and now that is worth half a bill. You've just lost $500 million. You want to hang in there and let it go down to 250, or
do you call it quits?
What are you going to do? And so some of them they're getting out altogether. Others are just saying time out for now. And then the ones that are staying in it, they need to make sure that the loans that are, being done are actually going to be loans that are going to be paid on over the next, 6 to 12 months. And so nobody wants to write a loan knowing that that person's not going to make their payments for the next 6 to 12 months. One of the sayings we have in the industry is we're not in the foreclosure business. We don't want to see these loans go into foreclosure. That's not good for anybody. That's not how the lending institutions are built to run. They're not built to make their money off of foreclosures. They're built to make their money off of servicing. And so when the servicing hurts, that's not good. And so anyways, that's part of what's going on, and that's for everyone that's staying in. For all of our investors, Network Funding's got about 35 investors that we work with. For the investors that are staying in the game, all of their underwriting criteria is really starting to get skinny. So it's kind of think back to how it was after the housing crisis, where they were, kind of had to have an overreaction and overcorrection. That's exactly, not exactly, but it's similar to what's going on now. Is they're having to go, okay, let's make sure we're closing loans that we are really confident are going to make their payments. And so we're seeing a lot of things.
Their taste for risk is totally depleting.
Yeah. Now, with the coronavirus, some of the logistical things are also easing right now. So there is some good with the bad.
Yeah. Before we jump into the changes,
yeah.
See if anybody dropped us a question or anything. So we did the logistical update. And so any questions you have around that, and we just kind of gave a high-level overview of the Fed cutting the rate to 0 and the unlimited mortgage-backed securities and all the servicing hemorrhaging that's happening right now. But if y'all have any questions around that,
yep,
we're peeking right now to see is there anything we need to address.
Yeah, and Rich Jefferson's he's watching right now. Rich is our VP of Sales. We love Rich. And he just dropped a nugget. Yeah, he said the 10-day close will be a giant advantage when we come out of this temporary slowdown from COVID-19, and it's because sellers are going to want to close quickly. And so realtors, be cognizant of this. Our 10 days still available now. It's probably more important than ever, and that the importance is only going to climb. Kirk Zickler, what's up, buddy? Thanks for tuning in. See your question about cash outs and the restrictions on that. We'll get to that in a second.
Yeah, those are coming up.
So hang tight. All right, let's jump into the changes. We'll start first with the appraisal side of things. Jonathan, can you see the screen?
Yeah, so some things aren't getting bad. Some things are getting better. And so the first two we're going to hit on, I would say things are improving and helping streamline and work through some of this, uncertainty and ambiguity that we have. Appraisals are typically where the appraiser goes into the home, scheduling appointments and all of that. Right now, they're doing desktop appraisals on some deals where they can look at a computer, look on the MLS, look on HAR, look at pictures of comps and things that have sold, and they can do the valuation based on that.
Yeah.
And so the thing that I would say, and Austin and I, is, as a listing agent, you want to make sure that house appraises. And so if that appraiser is not physically getting to go in that house, many times on the MLS or HER, you're only putting 15 photos of the house. So if you have 40 photos and you only put 15 on the MLS, I'd make sure that appraiser gets all 40 to really show them, like, here's the whole house. Look at
the condition of the home.
The condition of home, everything, because we want to make sure that, appraisers aren't too conservative in their valuations.
Yeah. And again, a lot of this stuff is temporary. One of the things that's out there is called a property inspection waiver, or a PIW.
Woo! Those are awesome.
Those are sweet. And
it's a good word, PIW.
If you've got a transaction right now and you find out that it got a PIW, that's legit, and it's good news for everybody. So the PIWs are great. That's coming from Fannie and Freddie when they basically feel really confident with the setup of that loan. So we know lately Freddie's been given a little bit more, so something to be mindful of. As far as purchase transactions go with appraisals right now, the traditional appraisals are no one's saying don't do it. It's just we're now allowing for the ability for desktop or exterior only appraisals. So we'll just go through the list real quick. So for a purchase transaction, if it's a principal residence, you can go traditional or desktop. A second home or an investment property can go desktop appraisal as long as there's at least 15% equity in that property. So if you've got 15% or more, then it's eligible for a desktop appraisal. You want to go through the refis?
So the next one is rate term refis. Fannie Mae and Freddie Mac is allowing traditional or exterior on those. So those are good things. And then on the non-agency, they're going to be a traditional. And then the next thing is a cash out refi. So there's two types of refis. A rate term where you're just changing the rate. But the cash out, you're pulling cash out. Those tend to be a bit more risky. So the only thing available for those is traditional appraisal. So they will be going inside still. And then new construction to be the next thing to talk on is they're going to be traditional because that's kind of self-explanatory.
Yeah, and the difference between a desktop appraisal, y'all, and an exterior appraisal is obviously an exterior. the appraiser is still going out to the property,
the neighborhood,
and taking pictures of that home from the outside, just not going in. If you do have an appraiser going into the house, reach out to us or reach out to whoever the appraiser is, or if you're not working with us, you should be, but if you're not, reach out to whoever you're doing your business with to see what their protocols are right now for traditional appraisals. Our recommendation is to leave all the doors open so that the appraiser, if they're having to come into the house, they're not having to touch anything, leave all the lights on. And so that's one way that you can help the appraiser, and you can help whoever the homeowner is or the tenant be able to accommodate that and keep it as safe and as quick as possible for
sure.
everybody.
So thing to take home is lots of flexibility around appraisals. And so 2 more things we're going to hit on that we're going to say are good things or beneficial for what's going on right now. The next thing, Austin, you tell us more about the tax return verification. What's going on there?
And we just got a timely question from Kelly
there
over at Title Houston. What's up, Kelly?
What's up, Bubba?
Yeah, great question. Kelly was asking, she was anticipating it. How will the VOE changes impact closing timings? So the 2 of the things that have also increased with flexibility lately are tax return verifications, temporarily suspending that requirement to get the TRVs from the IRS. So that's good right now. And VOEs, verification of employment. Y'all, right now, there's a
lot of
I don't know that there's I don't know that there's anything that's more important than verifying your employment. And so this is a big deal. And then now you've got all these companies that are working from home. And how do we typically verify employment? Well, with the HR department at these companies. So there's a lot of slowdowns happening with VOEs. Title companies are getting affected because we can't fund unless we get that final VOE. So as you're going through the loan process, there's going to be an initial verification of employment where we're confirming that what you told us you get paid is indeed what your employer pays you, and that they plan to keep you on board at that same pay rate for the foreseeable future. So the verification of employment is an extremely important document. And we also have to verify on the day of closing that you are still employed, that situation hasn't changed. And I mean, that's reasonable, right? Because of what's going on. I mean, you could have a loan or a company or an individual that was great a week ago that's not so great today. And so the VOEs are important. Where they have increased the flexibility is now we don't have to get that from the HR department. We can get it from a supervisor. And it's not as formal as it used to be. Still has to be accurate, still has to be truthful. We don't want anybody committing mortgage fraud. But they have increased the flexibility on who can provide that final.
Yeah, you think about a normal company might have 20 people in HR and they have 5,000 employees, whereas most employees have a manager that has maybe 5 or 6 people that report to him. So it's a lot easier to get in touch with that senior manager than get in touch with someone at HAR in those big companies. So that'll help expedite some of the process as well. So those are the good things that have changed, and all these are temporary. So once we come out of this, all of this goes back to normal, but this is just temporary. So we'll get into the unfortunate things, but people can understand what's going on, why we're taking, well, not we are, but just the lending institutions and lending industry as a whole is taking these precautions.
Yeah, and just to clarify, the TRVs, if you're not familiar with what that is, that's the tax transcripts. So confirming, just like the VOE, it's confirming. The VOE is confirming that what you told us you get paid is what you get paid. The TRVs confirm for us that what you said you filed with the IRS is indeed what you actually filed. So that's what's going on there.
Yeah.
All right, let's jump into self-employed borrowers. This was one of the bigger changes that came out.
It hits all of us. Me, Austin, a lot of the real estate agents we work with, insurance agents, title officers. A lot of us are self-employed or 1099 or stuff like that.
Yeah. So if you are self-employed or you've got self-employed clients, you need to understand this. This is very important. One of the most important things we'll go over today. So that if they're increasing the reserve requirements. So if you've got 12 months of reserves, and what reserves are is that is your PITI, so the full monthly payment for your property. So even if you're not escrowing, what would that payment be if you were escrowing? So the homeowner's insurance, the property taxes, alongside with the principal and the interest. That is the PITI. So when we talk about reserves, we're talking about 12 months worth of PITI payments. So as a self-employed borrower, if you have 12 months of PITI reserves, then you're good to get your full qualified income. And the way we qualify your income is we're going to look at your last 2 years, and those are going to be averaged together. Typically, that's how it's established, the qualifying income. If you don't have 12 months reserves, though, which is a lot of reserves for some people, if you don't have that, that's okay, but they're going to dock your qualified income by 25%. So you're only going to get 75% credit for your qualified income. There's a lot we could say about that.
Yeah, I mean, I think just the lending institutions as a whole just assume that 2020 might not be as great as 2018 and 2019 were. So if you made 100 grand in 18, 100 grand in 19, it's like, oh, my average income's 100 grand, so that should be my qualified income.
Yep.
Well, because of the way things look so far in 2020, I mean, you saw the unemployment number shot up. I mean, it was unreal. So they're just assuming we might make less in 2020, so they're going to dock you 25%, so you get 75,000 credit in that situation.
Yeah, so they're really, in addition to that, the thing that we talk about all the time is the ability to repay. And so, we're looking at the borrower's ability to repay on this mortgage. Obviously, the more money you make, the more likely you are to be able to repay your mortgage. And so when they start shrinking those guidelines on how they qualify the income, that's essentially what they're doing. They're making sure that you're overqualified. So they're essentially padding their ratios to make sure that, okay, hey, yeah, we feel more comfortable about this. Yep. And all these changes, y'all, this was current information as we're giving it. So depending on when you watch this video, or even as we're talking right now, something could be changing. So next week, that calculation could go from 75 to 65. So don't be, shocked if some of these things change.
And just remember, this is temporary. If you're buying this summer and we come out of this, then we can go back to calculating it the way it used to be originally. So it's just a good thing to keep in mind.
And of course, my computer just timed us out, so we lost our notes.
Oh, there we go.
Awesome.
Back in action. So let's go to the next one. So we did self-employed.
Self-employed. All right, rental income.
So might not affect too many people, but it is a substantial change. A lot of people have rental properties. In Houston, a lot of people have apartment garages or, might have one or two single families in their investment portfolio.
Yep. So how is that getting impacted? So essentially, if you are looking at rental income, they are basically, my understanding is, not giving you credit for the rental income. You have to qualify for your mortgage, getting hit for the full payment on that rental property. So that rental property's PITI is added into your debt to income ratio. So you've got to be able to qualify carrying,
it's almost like the house is vacant, essentially.
Right. Think of it like that. Unless you've got some really solid reserves. I think it's 6 months for each. 6 months reserves for each property that you have. So if you've got an investment property portfolio, Jonathan's got 3 investment properties. You would have to, whatever the PITI is for each of those properties, we got to have 6 months of that for each of those.
Yeah, and the reserves can come from a lot of things, money market accounts, savings accounts, checking accounts. So
flexibility on that to an extent. So just be cognizant of that. Realtors, I mean, we're giving you guys, I know this is a lot of information. We'll put it in writing on our Facebook page and Instagram page, so you've got that as a resource. But we're telling you this so that you're prepared right now. As you're talking with your clients, maybe more than ever, you need to understand how qualified they are. And so this is, ask them about their employment. Ask them about, if they say, oh, I'm self-employed, how's it going for you right now? We're seeing a lot of scrutiny over, if someone's commissioned right now, or contract work, like how is their business going? And if they've got rental properties, I mean, someone that, like I said earlier, someone that might have been a well-qualified borrower 30 days ago might not be a well-qualified borrower right now. And it's just getting skinny out there. So you've got to be careful with the contracts you're putting out.
So we're almost through all the bad. There's 2 more things I guess we need to cover. That's kind of on the bad. Everybody's like, man, this is depressing, guys.
This sucks.
That's why we're drinking Topos, guys. I hope y'all are having wine or coffee, and we might indulge.
This might be tequila.
Yeah, we're gonna indulge in adult beverages once we get through our workday as well. It's been a rodeo of a couple of weeks, and but let's get into the last 2 things. So the government-backed loans, so FHA and VA specifically.
USDA also. We don't do much of that. But.
Yeah.
They're raising the FICO requirements. So a month or 2 ago, we could have gotten down to 580 on a lot of them.
Mm-hmm.
Now they've launched them up to 640 plus. We've got and then layers on depending on the debt to income ratio. So the higher the debt to income ratio, the higher the credit score needs to be for that person to still qualify. In addition to that, though, what's happening from the mortgage rate pricing side is the rates on those are just, they're astronomical right now. I mean, literally, you can't, I don't know if you can pull it off as a qualified mortgage at the moment if you're starting today. So that is really, even though like the guidelines are still there and technically these programs are still there, your ability to actually do it, I'm not super confident in at the moment. And so these might just need to be a group of loans that, hey, if you've got an FHA borrower or a VA borrower, they might need to sit on the sideline until the coronavirus is over.
Usually those loans are a lot less payment. Maybe they give some money for somebody to get to a conventional loan.
Right. Yep.
So just remember that things are narrowing both from the debt to income and the FICO score standpoint in some of these government-backed programs.
Yep. So, like, just to give you some examples, so 640 minimum FICO, no manual underwrites are being allowed. If the debt to income ratio is 45%, then depending on the investor, it's going to go up to 640 to 680, from 640 to 680. And then if it's a DTI of 50%, then we're seeing 680 to 700 with a lot.
Yeah, which 50 is the max, right? So 50 is the max DTI. So if you're that max DTI, that FICO score's now got to be almost at 700.
Yep. All right. Well, and like I said, we don't do a ton of FHA and VA business. That's not a big part of our personal production. Yeah, and a lot of our referral partners. So if you're a referral partner of ours and you're watching this, that might not affect you as much as the next one does.
Yeah, this is the last one and the biggest one probably. So
jumbo loans. Woo! What's going on?
What's a jumbo loan? First off,
so jumbo loan. Good question. Jumbo loan is anything that is north of $510,000 in most areas, and so
on the loan amount.
On the loan amount. So purchase price can be north of that, and you can still have a conventional loan, but it's the loan amount. If the loan is higher than 510, technically 510, 400. If it's higher than that, it's a jumbo loan. Mm-hmm. This is like literally like changing daily right now as to what's going on. So if you have questions, the safest thing to do is give us a call or shoot us a text, and we can let you know what's happening at the moment. We've had several jumbo investors literally just shut down their jumbo programs.
Yeah.
And so we're seeing there kind of seems to be some momentum in that direction at the moment. So hopefully they don't all get out. The ones that are staying in are definitely going back to more basic, more vanilla stuff. So we don't have the 10% down, no MI options anymore. So we're seeing the jumbo investors that are still in the game going to 20%. We're seeing them ratchet up their reserve requirements.
Big time. I mean, almost 12 months.
Yeah, 12 months.
That is
sometimes more.
Yeah,
depending on the situation.
Yeah, if you have a current residence and you're financing a new residence and you're trying to carry 2 notes.
18 months.
Yeah, it could be 18. So that's a big one. Is a lot of people, I will have the money for a down payment, have the money for closing costs, have a little bit of money left in the bank, but it's like now you're going to have maybe 18 months in some situations of reserves. And so that's a big number.
It's a lot. And so, I mean, to be just like totally honest, like the jumbo news that I've been seeing this week has been a little discouraging. I know that we all know this is temporary, right? We just don't know how temporary this is. But this virus is not going to last forever. We know this is going to come to an end. And when it does, the difference between the financial crisis that we experienced a decade ago and now is why we're going through this. We're not going through this because of a housing bubble or mortgage fraud. Like, we're going through this because of an external virus. And so it took a long time after the housing crisis to see lenders like relax and bring these programs out. I don't think that's going to be the case this go around. I mean, we could see some lasting changes. I think it's more realistic that they're going to bring these programs back
turn
online,
the nozzle back on
pretty quick. But for right now, for the foreseeable future, they're starting to get really tight on those jumbo loans. We still have several investors out there. It's one of the benefits of working with a company like Network Funding is we still have several options at the moment for jumbo loans. And so if you've got one and you're having trouble getting it financed, give us a call. Let's talk about it. Jumbo interest rates are not in line with conventional ones right now. So set your own expectations, set your clients' expectations that if you're getting a jumbo loan right now in this climate, it's not going to be as cheap as they might be thinking they're going to get with the news that's been out there about what rates are doing. They're not talking about jumbo rates. Jumbo rates they're higher.
Yeah, usually they're talking about the average prime offer for conventional loans. So
yep.
Let's go to comments and see if anyone has anything on some of these, unfortunate changes that we're going to have temporarily around the self-employment income and FICO scores and debt to income and reserves. A lot of that's getting squeezed. So I just want to make sure, go ahead and drop a comment. Let's make sure we touch on some of that before we go into the last part of what Austin and I want to cover.
Yeah, got some good questions in here. Kirk, I think you might have asked this maybe before we got to it. For self-employed, how is verification of employment being achieved? Any new restrictions? So for self-employed borrowers, that's a great question. Self-employed borrowers, their business has to still be functioning. So if you own a brick and mortar shop and that shop is closed, like, we literally can't close on that loan until things are back open. If you are still in business, you just need to be able to prove that you are still in business.
One of the essential businesses.
Yeah, as a self-employed borrower, the VOE is not something that matters. You're the company, you're the boss, and so what we need to verify is that the company is still in good standing. All right, Diana asked, are TRV and VOE updates you're referring to also applicable to jumbo loans or regular and conventional only? That's a good question, Diana. I believe that these apply across the board at the moment. Again, that could change based off of program and the investor, but my understanding is that this is universal at the moment for virtually all the programs.
That's the coaching we've gotten so far.
I'll confirm that. If Rich is online and still listening, maybe he can weigh in on that for us. Jonathan Cohen asked, is that for refi as well? Yes, these guidelines do apply to refinances as well as purchases. It's a good question. So it looks like that's pretty much it. Kelly asked, how will stimulus impact interest rates? We are gonna land the plane on that. Here in just a second. So yeah, let's go there, Jonathan.
The big rescue mission, the stimulus relief, whatever you want to call it.
CARES Act.
I think the CARES Act is the official acronym. I don't think we spent time looking up what it means.
What it stands for.
But that just shows you how busy we've been. But it is called the CARES Act in the media and most language that people's been using. So the CARES Act, the big thing to know is that the government stepped in to allow consumers, even investors who have rental properties, request forbearance. And what forbearance is, it means you have the ability to defer your payments. Not get free money, but just defer your payments. And the way that we've read the language so far is that you apply for 6 months.
Yep.
And then you get your 6 months of deferment. And then after that, you have to reapply for another 6 months. And so you potentially can get 12 months of forbearance.
Yeah, and I think that might vary a little bit from servicer to servicer. That's certainly Fannie Mae and Freddie Mac's. Mm-hmm. So you'll have to check with your own servicer. But yeah, so forbearance is out there, and it's gonna, it's not an automatic 12 months. You've got to reach out, you've got to request it. They can't deny it to you, so that's nice. But then how it's set up and for how long, that's going to be a a little bit more case by case.
Exactly.
So
I think it's great. I mean, there are a lot of people that are in bad situations and need that type of assistance. And so I think it's fantastic. It's beneficial. But what Austin and I want to do is kind of not talk on the dark side of this, but some unintended consequences, I guess. That's kind of the word we've been sharing a lot today, is everything that's going on with our government's decisions and the Fed has had some unfortunate unintended consequences. And so the things that we've known about the CARES Act is there isn't any language in there telling these lenders or mortgage servicers how to set up repayment plans. So they kind of left it open. Yeah. So it's going to be very subjective. Each lender is going to have their own repayment schedule, and we have no idea what that looks like. We kind of have 3 scenarios from people we've talked to and things we've watched that we think could happen. So if you do go into forbearance, you do defer your payments, here's are 3 things that we can think can happen.
Yeah, so that's the thing that, as you're going into this, if you're thinking, okay, sweet, free money.
Don't have to pay my mortgage.
Not quite.
Can cover my Disney
Not
Plus.
so fast.
Cover my Disney Plus subscription and my new Netflix subscription and not pay my mortgage.
No. If you need it, use it. I mean, guys, and this just, even outside of this, if you ever find yourself in a situation where finances are tight and you can't make your mortgage payment, call your lender, call your servicer, and ask them if they can work with you. They do not want you to go into foreclosure. I promise you. And so what we're seeing now is some proactive measures happening federally across the board, anticipating this being a reality for a lot of people. And so if this becomes your reality where you can't make your mortgage payments, that's when you go into forbearance mode. We really want to encourage you to continue making your mortgage payments as long as you possibly can, because when the forbearance period is over, you're going to still have to pay everything that you skipped. And that payment, we don't know. It's going to vary from servicer to servicer potentially. I mean, the government could give some more guidance on what they can and can't do.
But right now
there is not any guidance. And so it could be a balloon payment at the end of this. So imagine skipping 12 months and then having to do a balloon payment. Like, that would suck. I don't think that that's going to be the case.
That's really harsh and probably the worst scenario. But it could happen.
And so if you're going into the forbearance stuff, you need to be talking to the servicer. What are my repayment options? What do they look like? So that's going to be really important. What I think most people are going to do, what most servicers will probably do, is they'll probably do an add-on to your mortgage payment.
Yeah.
So give you the option to.
Yeah. So adding on, I think, say your mortgage is close to $1,000 a month, and you go 12 months without it, so you owe them $12,000 still. So maybe they'll make you pay extra $250 a month for the next 4 years or something like that. I mean, that seems reasonably fair. I don't know. It might be more aggressive. That might be $600 more a month. But what they're going to do is add it on until you pay it off, and then your mortgage will go back to maybe $1,000 a month.
Yeah, I think about it like when you have an escrow shortage, and they're like, hey, you're short, we need to, get caught up. And so there will probably be a period of time where they're trying to catch you up. I think that's realistic.
Giving you an option of one-time payment or...
Over how long? Over the next 6 months, 12 months, over the life of the loan? So those are conversations. If you find yourself in a forbearance situation, it's not, oh, cool, you got a year of free payments.
Free payments are living.
Someone's paying that for you. The servicers, the lenders, they're covering that right now. And so they need to be made whole. You asked to borrow that money. They lent it to you expecting repayment. Obviously, unique situation, but you guys, we just want y'all to be safe when you're thinking about this stuff. The other thing that they could do is they could add it on to the end of the loan.
Yeah, which would be the best case scenario if you're a consumer. Yep. You go into 12 months of forbearance, you've had your mortgage for 2 years maybe, so you're on a 30-year, so you're in year 28. They'll just add on a whole year at the end. So you end up having a mortgage for 31 years, that you were supposed to pay off in 30, but you pay off in 31. They add it on to the end where you would just resume your payments like normal. That would be the best, but they might not be able to do that based on some of the information we're getting.
I think that's a pipe dream.
I think it's a pipe dream. They're getting hurt, and they're going to need to get paid. I mean, we all need to do our parts. I've seen a lot of people out there supporting local businesses, supporting restaurants, and kudos. We've been getting takeout as well and doing drive-through stuff, and I think the same thing. When you have the ability to pay your mortgage, it's good for the overall economy that we all start paying our payments again so they can lend out money to help people become first-time homeowners, and
Yeah.
and all of that. I mean, we're all connected.
Yeah, and that's the thing. I've been thinking about this a lot, Jonathan. Is I feel like you're either part of the problem right now with the coronavirus, or you're part of the solution. And it's so cool to see. Lydia Davies over at Norhill Realty mentioned earlier this week about like, hey, closing gifts. If you're thinking about closing gift for one of your clients right now, go buy them a gift card from a restaurant, a local restaurant. I think that was such a great idea. And so we're seeing a lot of stuff out there like that, like, support your local business.
Mm-hmm.
We need to have the same mind, especially in the real estate world, about mortgages, because if people stop making their mortgage payments, we're going to see a sustained period of these tight guidelines. We could see
higher rates.
We could see higher rates. We could see, bad effects on home values. We could see a blossoming of foreclosures, and I think we probably, unfortunately, will in about a year or so.
Which would affect the stock market, affect our retirement accounts.
It's going to affect your comps on your deals. And so if you hear
everything.
Someone casually talking about forbearance or whatever, like, tell them,
proceed with caution.
yeah, make sure you're smart. Be a part of the solution, not the problem.
Yeah. So the last thing we want to hit on here, or two more things, but the next one is the credit, right? So if you're not making your payments and the credit bureaus know you have a mortgage, how is that going to be reported on your credit report, on the bureaus?
Yeah, we know that they can't ding you for late pays. That's in the CARES Act. That's explicit. That's good. And I really liked that. When I saw that, I was like, okay, that's great. So if you go into forbearance, it's not going to, they're not going to ding you for late pays for that. But what they do show, typically whenever there's a forbearance thing from a natural disaster, that's still coded. There's some language out there right now that looks like it might not be as coded quite the same way.
It's kind of gray right now, and hopefully we'll get more information.
And that's scary to me, because I'm like, well, I don't want to do something hoping that it doesn't affect my credit. Like I need to know. And so we know that you're not gonna get dinged for late pays for the forbearance side, but this is still gonna be reflected on your credit report, like you were saying, Jonathan. Like you've got a mortgage, it has a start date, it's got a balance, and then it's got a length of time. There's no way around being able to show that you were in forbearance. That's going to show up. The question is, how is it going to affect your credit after?
Yeah,
once you come out of that forbearance.
Yeah, your ability to get future financing. So if you're thinking about buying something, a house, or some big thing you're going to get financed in the next 6 months or year, I would really weigh that decision based on should you do forbearance or not.
Yeah, and so exactly, because the underwriters, so maybe it doesn't affect your credit score, but it's still going to be on your credit, and it's going to be part of your credit history. How do investors and underwriters look at that 12, 18 months from now?
Yeah.
We'll see. But because they're always going to be concerned about, again, your ability to repay. And so we want you guys to proceed with caution with the whole forbearance thing. It's there if you need it. And if you need it, we're encouraging you, absolutely use it. But if you don't need it, do what you can to keep paying your mortgage. That's our advice.
Yeah. So that was the big things we want to hit. Logistics, just an update on the Fed, some of the good changes, some of the bad changes, a little bit about forbearance and the CARES Act. So we just want to open up right now for any questions you have about any of this stuff or just anything. Austin and I just want to be available for a little bit for everybody who tuned in and who's engaging and dropping questions. We have anything?
Yeah, we'll sign off with a couple of closing statements here. But if you've got any additional questions, drop them in. Kelly, do me a favor. I'm not sure what all you're referring to with your question of still with no prepay penalty. Are you talking specifically in regard to the forbearance stuff? Yeah, right now, network funding, we don't have any prepayment penalties on any of our loans that we do. That we don't believe in that. We believe in the opposite. If you want to pay early, we're good with.
Good for you.
Good with that. So yeah, let me know if that didn't answer it. So yeah, think about your questions. Anything you've got, put it here. Obviously, y'all know how to reach us if you think of something after this. But yeah, we just want to. Yeah, on a personal note, man, this is hard. This is a hard season, and my heart, like today, is going out to our realtors and our referral partners, especially if you do business in the north of $500,000 purchase price range. I think that's going to be hard territory until we get out of this. So if you've got someone that's thinking about listing and they're thinking about listing in that price range, man, I don't know. You guys are in a tough spot, and man, we're thinking about you guys. We're praying over y'all every day. If you have specific prayer requests, we want to pray for you.
Yeah.
I've had my moments over the last few weeks.
Yeah.
You've had yours.
I've had mine. Yeah.
But yeah, it's hard, y'all. I mean, this is a hard season. And something our friend Ken Perry over at the Knowledge Coop said in his recent video that we shared on our page. Go watch that. He talks a lot more in depth about the forbearance stuff if you're curious. But he was talking about what we put in our minds.
Yeah, and we have a lot of extra time, a lot of free time, more than usual. I mean, I know some people are really busy because of what's going on, like the healthcare workers. They don't have free time, but some of us at business might be slow now. We just have this extra free time. It's like, what am I going to put in my mind? You know, am I just going to binge and watch Netflix, or just, you know, read all this bad news and, you know, and let that, you know, draw up fear and anxiety, or what am I going to do, right?
Right. And so Jonathan and I, if you don't know, we love Jesus, and we love him more than anything. And that's where we go every day throughout the day. We go back to Jesus. We go to his word. We go to the scriptures. We go to prayer, and we encourage each other to do that. And we just want to encourage you to do that as well. Like, no matter where you're at emotionally right now, maybe you're doing great. Maybe you're loving this enforced isolation time, or maybe you're really having a hard time. Wherever you're at, Jesus is there for you. He loves you. We love you. We'd love to talk to you more about him. And one thing right now, if you're looking for a great show, The Chosen. Holy mother,
that's awesome.
That is a great show.
Yeah, it's the largest crowdfunded TV series in history. I mean,
crowdfunded anything in history.
Crowdfunded anything.
Yeah, incredible. It's an incredible show. It's about the life of the disciples of Jesus, and I've never seen a show or a movie portray Jesus like this. I mean, the way they show him, y'all. I mean, if coronavirus didn't make you ready for Jesus to come back, this show will. The way they show his just his personality and his humor and his playfulness and his heart is so good, but also just the way that they show the people around him, the way they break down the disciples and their personalities is really cool. So if you're looking for a great show, a good family show, something good to put into your mind right now, binge Jesus.
Binge Jesus.
That's our recommendation.
That's the hashtag for the show. So download the app. It's on iPhone or Android. But we'll wrap up with whatever questions that just came in, and we'll knock them, and then we'll get out of here. Anything came through the chute?
Kirk Ziegler said it's time to learn the language, learn anything.
There you go.
Amen. Work on your Espanol or something. Rich Jefferson still tuning in. Thanks, buddy. And yeah, he said it's really hard right now for everybody, and it is. We're here for you guys. Literally, like, if you need somebody to talk to, there's nothing we'd love more
give us
than
a
to
shout.
talk to you. So let us know how you guys are doing. We're doing all right. We're hanging in there.
Working out of garages.
working out in the garage. Trying to work on my coronabod. I don't want to gain the COVID-19. I want to work on that coronabod. So anyways, y'all stay safe. We love you guys. We appreciate you.
Absolutely.
And we'll catch you around. Maybe we'll try this again next week.
All right, guys. Like up, share the video.
Adios.
Boom, boom.